Hi, everyone. Thanks for tuning in. I am going to go over the rent roll today. The rent roll, when it comes to commercial real estate, is probably the most important item that you're going to want to get. Look at it this way. When it comes to, let's say, a movie, right? You've got the movie cover, like let's say the poster when you're walking by AMC or something. You got the poster of the movie, you've got the movie trailer, and then you've got the actual movie itself. The online listing or maybe like a brochure you might have looked at, imagine that being the movie cover. The movie trailer is kind of like the rent roll. The rent roll is going to tell you if you want to dig in deeper into the property or not. And in addition to that, the rent roll is a very convenient document to look at, which will let you know all the high level details of each tenant and each lease. And with that, you can use to guide yourself if you want to dig in further into the deal or not. A rent roll is normally used when there's two or more tenants within the property. Sometimes a property may just only have one tenant, like a single tenant deal. If it's a single tenant investment deal and there's only one lease to look at, you don't need a rent roll. In that case, you do what's called a lease abstract, which is basically one roll of a rent roll. And you'll know what I'm talking about when I get into it in a bit. This is something that's going to go over a majority of the items that you will normally see when it comes to a rent roll. And this is to be used as a guide. Not every rent roll will be this detailed. And sometimes rent rolls will go ahead and break it down even further. For example, I'll get here in a bit, but let's just say we start talking about CAM. Here I just have a CAM per square foot. But there are some rent rolls where they've got your common area maintenance per square foot, your real estate taxes, real estate insurance, and they break it down into three different columns. But here it's just one because we're all on the same page when we're talking about what CAM is here. But anyway, going back to the very beginning, unit. The unit here is really just to let the person know what the address or the unit of the space is that we're referring to. If you've got a building with 10 units or 10 tenants, each tenant is going to have their own individual address, and that's what goes into the unit column. When it comes to the business name, a lot of times I'll see, if let's just say Chipotle as your tenant, right? If Chipotle is your tenant, you want to put Chipotle here, whatever they're doing business as, because from a review standpoint for the investor, for anyone looking at it, it more or less is easier to digest. If it's like, I don't know, let's just call it Chicken and Steak LLC. People are going to have to dig in and say, hey, what's Chicken and Steak LLC? It's not confusing, but it just adds more questions and additional layers. You want this to be as lean and as to the point as possible. The less questions you can generate from a rent roll, the better the rent roll. So answer as much as you can in the most efficient manner possible when it comes to a rent roll. So again, go with Chipotle. Don't put in Chicken and Steak LLC. So that's the business name. That's what goes there. Basically, in other words, to be specific, don't use the LLC. Use the DBA. Okay. The size, the square footage. That's going to be the square footage for each space within the building. So let's just say, going back to a Chipotle example, if Chipotle's got 3,000 square feet in a 10,000 square foot building, you're going to put 3,000 square feet there. Okay. Pro rata square foot. Pro rata square foot just means, let's just say in that example, again, you've got 3,000 square feet. Let's say the building was 10,000 square feet. The number that will come up there is 30%. So what that means is Chipotle has 30% of the 10,000 square foot building. Okay. Lease start date. That's just the date that the tenant went ahead and moved into the building, or not moved in, but that's when their lease signed. I say that there's a very big difference between the date that the lease started versus when the tenant moved in, because the tenant could have moved in. The tenant could have signed a lease on January 1st. And the thing is that they could have had, call it 6 months of going through permits, making sure the city is going to allow them to open. And then they're going to take another 4 months for construction. That's 10 months. And now they're not moving in until November. So you want that lease start date to be January, not November. And that just lets the earlier this date, the better. You want to show the longevity of the tenant. So let's just say again, let's say there is someone who signed a lease in 2010 and a 5-year lease, and then in 2015 the lease expired, but they had a renewal option. They signed in 2015, and then they had another option when 2020 came and they signed it. You want to make sure that you show the date that the lease started back in 2010, not 2020, because then you're losing out of 10 years of goodwill, right? You want to show that the tenant's been there for a very long time. The lease end date is going to be when the lease expires. So when it asks about the lease end date, the lease expiration is what we're talking about here, not the lease option. So if someone signed a lease back in 2020 and they've got a 5-year lease with a 5-year option, that means that their lease ends in 2025, and that they do have the option to renew. But that's not the question here. The question, what they want to know is, hey, when does the lease end? Which in this case is 2025. Rent per month and then rent per year annually. That's going to be self-explanatory. If you put in, sometimes I like to pre-populate these. I mean, if you do a rent monthly, if let's say they're paying $5,000 per month, you could put 5,000 there and come over here and put times 12. It'll give you the annual rent. Or if you want to reverse that and put 60,000 here and divide it by 12, you'll get 5,000 there. And then you'll have your per square foot for rent annually as well. So let's do this. 5,000 times 12. And then per square foot is just the annual rent divided by the actual square feet. So you've got $20 a foot for the rent for Chipotle. And that should all be pre-populated in terms of pre-formulated just to make your life easier. Right here, I'm kind of typing out everything just because we're doing this video and I'm showing you how it's done. But yeah, that's what the rent per month, per year, and per year per square foot looks like. Keep in mind too, when you're looking at the per year per square foot in different markets, like let's just say if you're looking out in California or New York, a lot of times they go rent per square foot per month. So instead of seeing $20, it's going to be whatever. Let me see. It's going to be $20 divided by 12. So $1.67. So you'll see in some places, $1.67 per square foot. Or I remember one time I was in California and someone was like, I pay $5 a foot for rent here. I'm like, what are you talking about? But then of course, I found out that it was per month. But yeah, that's what we got there. 3,000 square feet. Moving on is the CAM. So the CAM per square foot is going to be what they're paying for their pass-throughs. A lot of times you'll hear the words CAM and pass-through used interchangeably, and depending on the market, and depending on the broker, and even the owners that you're talking to, a lot of times they may have learned the industry from a different part of the state, the United States, and they'll use language from California or New York. And bring it down here to Florida, which is fine. But a lot of times you want to make sure that you and them are on the same page when you're talking about CAM. CAM, pass-throughs, triple nets. Those are some of the words I normally see when we're talking about it. So sometimes you have to pair it with explanation. So if you ask them, hey, what's CAM? You might want to clarify, hey, just to make sure CAM includes tax, insurance, property management, landscaping, utilities, everything, right? So just ask that to make sure. Lease type is going to be, for CAM purposes, let's put in, let's go ahead and put $8 a square foot for CAM. Lease type, you're going to have either one of two leases, or actually one of three leases. You're going to have either a triple net lease, which is normally abbreviated as NNN. A second one is going to be a gross lease, and the third one is just a modified gross lease. So triple net lease is just one where all the operating expenses for the property are passed on to the tenant. Now, even though we can say that all operating expenses are passed through to the tenant, remember how I said that this is just a movie trailer? When you're actually watching a movie, or AKA when you're actually reviewing all the leases, you're going to want to make sure that you review all the leases and dig into the operating expenses language to see if there are other things such as, is there a maximum cap to property management? What about property taxes, property insurance? Am I capped off to anything? Because there are some leases, specifically with the national guys, like a Chipotle or a Starbucks I've seen, they'll say, Starbucks, the tenant, they'll pay for your property taxes, but by the way, you can only raise them up 5% per year. And there are some cases, like just very recently, this year and last year, property taxes have gone up 20, 25% in some places, maybe more. And there are caps on insurance as well, which here in Florida in the past couple of years, we've seen insurance double, triple, through multiple properties. So it's very important that when you're digging, once you pass the rent roll stage and you're digging into the leases, you got to comb it with a fine comb and make sure that you are understanding what every charge, what the limits are. There were some leases I've seen where it'll say, property management is fine, but it can't increase any more than 5% per year. But then the property management costs are like 1% of gross rents or something, which puts you in a tough spot. That means you either got to A, find a property management company who's going to give you limited service, or B, come out of pocket, which is going to hurt your net operating income, which you could probably massage that to make it work. But you want to be very mindful of that. Okay. So, and then the last one that I was mentioning, modified gross, is really just a gross lease, meaning that the landlord pays for everything, but then there are some exceptions. That's a modified gross lease. And those exceptions could be anything. There's one I worked on this morning where it said, hey, the tenant will pay for their share of property taxes up to a certain year, and any increase after that, moving forward, they'll pay for their share. It really just depends on how the lease is done. So actually, wait, I take it back. That particular lease that I worked on this morning, it said that the tenant would pay no part of the property taxes up to a certain year, and then after that year is when the tenant would pay for the pro rata share. So basically, let's say if property taxes were $25,000 a year, tenant will pay none of it. But then if it increases above that, let's say it went to like $35,000 one year, the tenant would pay for their pro rata share of that extra $10,000 increase. So that's what a modified gross lease is. And in all the terms of every lease, everything is negotiable, which is why it's so important that when you're combing through it, whether it's by yourself or with your attorney or your partners, you got to make sure you know what you're reading. All right. Escalations. With escalations, it's only asking you, hey, I know that they're paying X amount of rent today. How much does it go up and how often? So a lot of times, some of the average numbers I see is, escalations go up, 2%, 3%, 4 or 5% per year. Or sometimes they'll say, it's going to be flat for 5 years. And in year 5, it'll go up 10% or 15%. There was a lease I was dealing with recently where it says, hey, I know the asking rent is $40 a foot, but how about we pay $35 a foot? But then at year 2, rent bumps up 20%. Like there's so many different ways to carve it up, but just know that when it comes to escalations, it's just asking, hey, how much does rent go up and how often? That's all it's asking here. With options, the option is earlier when I was talking about when the lease ends, let's say someone signed in 2020 and their lease ends in 2025. If they have a 5-year option, that means that in 2025, the tenant, Chipotle, they have I guess I want Mexican for lunch, by the way, which is why I keep talking about Chipotle or why I use them as an example. They have 1 year, 5-year option to renew. So all that means that in that case is that what you want to write there is 1 5-year option. Okay. That 1 5-year option there will tell the person who wants to buy this, will tell the investor that, hey, when Chipotle's lease ends in 2025, they can stay for an additional 5-year period if they want. So, and that option here in our market, it's a one-way street, meaning that the tenant has that right to renew. If they want to renew it, the landlord can't deny it. And that's standard, right? I mean, but just like what I just said, everything's negotiable. You could put in a 1-year option to renew for Chipotle, but landlord must approve. You can throw that in there too, and if they accept it, then they accept it. But just know that market standard is 1 5-year option to, or the market standard is that it's a one-way street. Tenant has that right to renew their option. So if it's a 1 5-year option, you put it there. If it's a 2 5-year option, 3 5-year options, a lot of times you won't see it go too much further than 2 or 3 option periods. The reason why is a lot of times landlords don't want a tenant controlling the space for so long because sometimes it can hurt value. It gives the tenant a little too much time to control a space, and the options are really to the tenant's benefit, not so much the landlord. So depending on who you're representing and whose side you're on, you're going to want to make sure that you negotiate the right way there. A security deposit. Okay, so before I go further, I'll let you know that these last few items are really it's more of a checklist. It's almost like a checklist because these items, like for example, the security deposit and prepaid rents, those don't affect the value of the property per se. I mean, they do to a certain extent, but not so much as the other things I just talked about. But what I mean by it being a checkpoint, a checklist, is that let's just say that you're looking to buy the property. You're going to want to know what the security deposits are, because when you go to close, the seller has to credit that to you anyway, in order to make sure you've got the deposit there. So once your portfolio moves out and they want their $20,000 deposit back, you've got it ready to give to them. If you don't note this and you forget or something, and the seller doesn't give it to you, and you're already closed and the seller done moved out of the country or something, you're going to be paying Chipotle $20,000 out of pocket. So in order to just check the box and just have all the information in front of you, I think that's important for you to just fill this out now, and that way, when the time comes to give them the deposit, you have it ready. And then when it comes time to close, you know exactly to tell the title agent, hey, by the way, make sure the seller credits the $20,000, that it belongs to the tenants. I have to put down an account to save for them whenever they move out. So the deposit is important to make sure you note it. Whether it's on the rent roll or not so important, but you got to make a note of it somehow. So why not just throw it on the rent roll? Next is prepaid rents. Regarding prepaid rents, sometimes the tenant will move in. They'll pay you first month's rent plus the last month's rent and a deposit. And if they pay the deposit, it's already here, right? But what about that last month of rent? You want to make sure you make note of it so that you ask for it to get it at closing as a credit. A few last things here is HVAC. This is very important. This is not an item that is so much on a lot of rent rolls. I only see them on about a quarter of the rent rolls. But if the HVAC repairs and maintenance but it's important to know who's responsible for repairs and maintenance and who's responsible for replacement. Because if the repairs and maintenance is to the tenant, sometimes there are caps to that you want to be aware of. If it's the landlord responsibility, you're going to want to know what those responsibilities look like. You're going to want to know, have there been repairs recently? When was it replaced? How old is it? There's a lot of questions there. And the replacement thing plays a role here too, is who's responsible to replace it. I split these up because sometimes it may say that the tenant's responsible for repairs and maintenance and the landlord is responsible for replacement. So you want to be very clear on who's responsible for what, because in a perfect scenario on a triple net lease, you'd want the tenant to be responsible for repairs and maintenance and the replacement of it. Now, if it's something that they pass on to the landlord, then when you're going to buy this, you're going to want to make sure you know what the condition of the air conditioning units are, what condition the HVAC units are. Because if they are in great condition, then good. It's not really that big of a deal. And you're going to be fine. Like, for example, if it's brand new or something, that's great. That's going, no big deal. But if it's towards the end of its life cycle, and if it's something that you see coming up around the corner, you're going to want the seller to help you take care of that through some sort of incentive. Last column here is other. I put other because that's just a catch-all. Sometimes there's just different things that tenants will pay for or landlords will have to pay for, or there might be some terms that you might want to throw in there that's very important. I'm working on a deal right now where on all the leases, this particular property's got 5 leases, and of the 5 leases, they all have this particular term that says the landlord has the right to cancel this lease within 60 days of selling the building. So what that means is that when the property sells, the buyer is going to have the right to go in there because they're the new owner, right? They're the new landlord. They're going to have the right to go back and say, hey, tenants, I just bought the building. I'm going to cancel all your leases unless you agree to pay this new market rent price. And in that particular deal, everyone has a discount. They're paying like half of what market is really going for. So essentially, all the tenants are going to be raised up to market, which is doubling their rent. And it sucks because a lot of the tenants have been there for like 20 years. They've been there a long time. You got some mom and pops in there. And kind of sad, but that's the world we live in, right? That's business. It's unfortunate, but that's just what happens. Now, at first, felt kind of sorry for the tenants, right? But you have to realize too, like, hey, how come the tenants just signed it? It's a short lease. You got such a great deal. Didn't it look kind of fishy? How come you didn't get an attorney? Yada, yada. So when it comes to commercial real estate and comes to business, you've got a lot of smart players involved. So before you do anything, always make sure that you get some proper guidance. Okay. Now, with the remainder of the video, I want to go over a few other rent rolls that would help you understand that not all rent rolls look the same. Very rarely do I ever see them look the same. And I want to showcase some different examples to help you see what else is out there. Okay. With this property here, I'm familiar with it because one of the businesses that we own is in here. And I want to show you what it looks like. Okay, so this property is this particular company who's selling this. They're a large company. They've got presence on Wall Street and everything else. They're definitely a very high level company. But I want to show you that even though their company is so high level and their information, they've got a almost 40 page package here that shows everything that you'd want to know about the property before buying it. This property was somewhere just under $10 million or so. This is in place. This is just in place reconciliation. That is not the rent roll. Looks like it, but it's not. I'm going to go ahead. That's a 10-year projection. Here's the rent roll. Okay. Here's the rent roll. And what I wanted to show you was that even though completely different company, high level company, the rent roll here you see looks very similar to the one that I just went over with you, right? You've got the tenant information there, which in this case, you've got the tenant name, contract status contract means that it's in motion right now, like it's active. These are their options, lease start, lease end, the square footage number. You've got the date here of when the lease. This is when the lease started, right? Hold on. No, I actually think this is just now. This is when the lease started, and this is just now, or I don't know when is that. I'm looking at it now, and I don't want to spend too much time in this video looking, but see, sometimes there are these weird things. These aren't weird. I just don't want to dissect it right now because I want to finish this video. But right here, we've got the rates that they're paying annually, the rents they're paying annually, the CAM that they're collecting annually, CAM per square foot right there. And this is the recovery method. This one, they actually break down, hey, you've got your CAM, you've got your management, 5% admin, insurance, taxes. They break it down a little bit further, but the bare bones, the structure of this rent roll is one where when you look at it, it's familiar with what we just went over. So I wanted to share this with you because the thing is that with the rent roll, a lot of times people will hear rent roll and they kind of freak out and like, oh gosh, how am I going to understand all this? It's got the same bones. It's really not that different. Moving on, the next one I'll show you is this one. So this rent roll here is one that was given to me from an owner's his a software that he was using, and again, it looks a little different, but what he did here is that it's all still the same. You've got your tenant information here, you've got a unit number there, square footage of the property, pro rata square footage, lease start, lease end. You've got the term, which is current, option one, and you've got the dates here. For example, option one is January 2018. The price per square foot. This FMV, by the way, I want to make a quick note of it. FMV stands for fair market value. That just means that, remember how I told you that there are some deals where the terms are just quirky? FMV just stands for fair market value, meaning that when January 28th comes around, they don't have a predetermined rent. They're not like, oh, it's going to go up 10% or 20%. They're just going to say, hey, when that day comes, we're going to do some sort of appraisal or some sort of like broker price opinion, and whatever the market rates are, we'll come to terms then, which in a way it could be beneficial or dangerous to either party. So that gets a little dicey, and I could go kind of detailed there, but it'll take a little too much time. I don't want to deviate too much, but just know that that's a small example of how there are some deals that can be done however you want. Reimbursement method, pro rata share. There are no CAM caps here, which is great. You've got reimbursement 5%. Oh yeah, actually there's one here. You see this Chinese restaurant, they've got a 5% annual increase cap. So whatever they're paying right now, so right here is showing they're paying $6.08. It can go up only 5%, which you got to be careful of that, because if it's only going up 5%, that means that it's going to go to $6.38 only, which is still less than the $6.90 everyone else is paying. What that tells me is that you've got a delta there. It looks like about 10% or so that as a landlord you have to be responsible for, which 10%, not a deal breaker, not that huge of a deal. But if you're buying based on certain returns for yourself or partners or whatnot, you got to be very mindful of that. Okay. So that's that example. This one is the last one here. I want to show you this. The rent roll here shows you everything that you need to know. I mean, this is that movie trailer we talked about. It shows you everything. You've got the suite numbers or unit numbers, the tenant names. You see how everything's got the actual tenant names. Don Julio, or not almost everything. For example, what's ABW Holding? That sounds like that LLC and not a DBA that we talked about. But everything else, VIP Nails, Nailed It, Gentleman Barber, Purple Ocean Coffee Factory, that tells you what business is there, and you can actually find them on Google or Yelp. So you can, but ABW Holding, like that sounds like a LLC, not a DBA. So that's tough. I'd want to change that. Square footage, GLA is gross leasable area. Percentage, which is that prorated share we talked about, lease start, lease end, price per square foot, base rate CAM, total CAM, increase date. Everything else is there. You see how everything is here. It looks complete, but there's some things missing. For example, right away, I don't know when the lease expirations are. I don't know if the tenants have lease options. I don't know what their escalation amounts are. See, it shows an increased date, but it doesn't show an increased amount, which, there's a lot of questions that would come out of this for me if I was trying to buy it. But yeah, it's still better than nothing. It's still good information. Down here you've got all the base rents and stuff. Oh, you know what? One thing I didn't review. I'm going to go back to it now, but you see how down here they've got a little bit of a chart where it says base rent, reimbursements, gross potential income, vacancy collection. I have that on the other document as well, which I'm going to show you right now. But since we're talking about when it comes to investment analysis, vacancy and collection with a building that's 100% full, there should be at least a 5% vacancy in collections here, because lenders are going to do that. They're going to add 5% in for vacancy and collections. So when you're underwriting it, you're going to want to add in a 5% as well, because let's just say right here, gross potential income $705,000 without a 5% buffer here, which in this case is about $35,000. That means that that really, you know what that really means? That really means that if you buy this building expecting to make $705,000, there's only one direction this is going to go, and that's going to go down. And I say that because there's no cushion. There's zero cushion here with a 0% vacancy in collections. So if you have one tenant that even misses a month, or there's some unexpected repair that the landlord is responsible for, etc., there's zero cushion there. So I actually don't like that very much. So you'll want to make sure you add that. Going back to the document that I mentioned, I want to review this part down here. So the reason why there's a rent roll up here and then there's this part down here is because as I am reviewing the rent roll, I want to fill all this out too, because this part down here is a very similar reason why I've got this part up here. It's more or less just like a mental checklist. It helps me stay on track, and it makes sure that I don't forget anything, because it's kind of like you're a pilot, right? Pilots, when they go in before every flight, they've got extensive checklists that they go through to make sure that they haven't forgotten anything, even though they've flown like so many miles and so many hours. They still have a checklist every single time. Just going through it real quick is that you've got your gross income, which is all the money that's coming in, that 5% buffer that I was talking about. You've got reimbursable expenses versus non-reimbursable expenses. Again, that just, when I see that, it reminds me, I better read the operating expense language and make sure I understand what the landlord is responsible for versus what the tenants are responsible for. You have your net income there, cap rate, price per square foot. These are items that will be pre-populated, and I hope you come to value. As long as you've got your net income, and if you have one of these three, and down here is price or value, okay? Because it could be price or value, just so that we're on the same page. If you have any two of these three, you can find out the third variable. So let's say if you had cap rate and value, you can find out the NOI. If you had NOI and cap rate, you can find the value. If you have NOI and value, you can find the cap rate. So they have a very neat relationship with each other. So keep that in mind. When it comes to operating expenses, the reason why I have it listed out here is that once you're filling out this rent roll, depending on the building and depending on many factors with the lease, it will itemize. Oh, this person is responsible for taxes. This person is responsible for insurance, utilities. This is how it's split up. Fire marketing, lawn care, management. All these items are just reminders to help you know, to help you come to the conclusion of what the net operating income is. If I was to boil this whole thing down, this video is probably close to 30 minutes now, I think, because I don't have a timer in front of me. The reason why we're doing all this is to figure out what is the NOI today, which is net operating income. What is the net operating income today? And what is the potential of what it can be? So a lot of times when you're buying a building, you're either going to buy it stabilized, meaning that what is my stabilized net operating income today? I'm buying it with all the nice, brand new tenants. I've got Chipotle in there. I've got Dental Sage, and maybe I've got, I don't know, Baskin Robbins or something. So you've got all the nice new tenants in there, new building. It's a stabilized income. So when you buy it, what is your year one net operating income? Once you figure that out, you've answered your question, right? What is your net operating income? Now, the other type of purchase is that there are buyers who are looking for value add opportunities. So you're using this and you're going through this whole process to find out what is the NOI today and what can the NOI be a month from now, a year from now, 2 years, 5 years from now, because you're looking for what the future NOI can grow to. So there's a different type of analysis that is done to help you get to figure out what is the stabilized value today versus what will the stabilized value be in the future once you're done repositioning it. But this right here is what I'm trying to show you is how to get a snapshot of where the property is today. To figure out where the property is going, that's a whole nother thing. I'll make a different video about it. But for now, just know that the rent roll that we are going over here and that we're dissecting, it's to help you understand where the property is today. All right. If you have any questions at all, don't be shy. Reach out to me, ask me questions. I'm happy to help. Thanks for watching, and I'll talk to you soon.